Lesson 3 that I not so affectionately call the good, the bad, and the ugly. And this is really saying, do our financial legal systems have integrity and how they work to serve on the objectives that we know they must serve? To have a safe, secure method by which we transact business, and that those in the market are dealing with us, giving objective information regularly so we can make proper decisions and therefore feel comfortable in the markets. Let's think about what happens if we don't have integrity. If our markets don't have integrity, we're not going to put our money there. If the stocks are there and we know that they're always fraudulent and deceiving people, why would I put my money in those companies? And if more and more people think that, the markets will collapse because there's no one providing capital. It's an important thing that our systems and our markets have integrity. The reason I'm making this point seems obvious, doesn't it? I'm making this point because, unfortunately, we've had horrific instances where the trust in the markets were misplaced and systems broke down. So we're going to start kind of in reverse order with the ugly, then bad, and then end with the good, end with the high side. The ugly is, or one example of ugly, unfortunately we have many examples of ugly, is what we call the subprime mortgage crisis in 2008. And that was something that caused global problems in all financial markets. The next one, we're going to look at the bad, which is Enron and what happened in their reporting fraud. The third is good, kind of an outlook for the future. Let's start with the ugly. And this is the mortgage crisis summarized on one slide. And just some background on who's involved and why this happened is it's simple. People want to buy houses. They want to buy a home or a condo. And they would love to have a bigger house or a better house or a bigger and better house. And yet they have a budget. There's only so much they should take in terms of a mortgage in order that so they can make the payments as promised and then not lose their home. Right? That's an important aspect for us to remember. Next, we have real estate agents. Guess what? They facilitate the coming together of a buyer and seller of a home. And also, they get paid on commission. The higher the sales price from the home, the more money they make. Just remember that, and we'll get back to it later. Then you buy a home, chances are you can't write a check for it. So you have to borrow money. Where do you go? You go to a mortgage broker, and they are paid a fee based on how large the loan is. Next, we have mortgage warehouse or bankers. They aggregate these loans, and then they bundle them, and they sell them in batches to get money again so they can loan more. So they convert the paper, which are loan documents, sell them, get more money in cash, and then they could do it all over again and lend more money. Then we have investment bankers, and they're selling portfolios of these bundles of mortgages, and they're creating things called tranches, which separates different risk groups inside a portfolio to differentiate the return and the risk for smaller, let's call them sub-portfolios of a big portfolio, and they sell them as securities. And, of course, they get paid, in this case, a percentage of what they're offering. Then we have rating agencies who are entrusted to objectively rate the risk of securities and give them a rating like AAA. AAA is the best rating. It's considered very low risk of default, and only the safest investments should get AAA. Then we have insurance companies that sell insurance on certain aspects of those securities, like a default or certain other risks for this complex offering that we now have of a bundle of loans that's been sliced up into little risk classifications. So insurance companies take off some of the risk of these investments. And finally, we have people with the money, the investors. Most of them are institutional investors, like those pension plans or large corporations or mutual fund managers. And they want to earn high returns with the lowest risk. Okay, so that's the background. So what happened? Well, the buyers get talked into buying a house bigger than they should because they can't afford it. They do so, and they seem to think they can afford it because the brokers come in and offer all kinds of artificial structures of loans so they can qualify for a bigger loan, therefore they can buy a bigger house. And these things are things like, oh, we'll not take any principal payments for a long time. Or maybe we'll loan you a higher and higher percentage of the value of the house because we believe that the house will go up in value. So all these are riskier and riskier ways to structure a loan. Mortgage warehouses are great. generate more loans. I get to bundle them, sell them, and make more money and put the money back in and do it all over again. Investment bankers say, great, keep sending me portfolios. I'll slice and dice them into tranches, sell them, make my money, get you money, and it goes again. Rating agencies, oh, they get paid a fee to rate the companies. So they sometimes lose their objectivity and may rate something a little bit more than they deserve. Maybe even rated as AAA when they probably know damn well that those mortgages are too risky, that the loans were too high relative to the ability of the home buyer to make the payments. But I'll close my eyes, stamp it AAA. And that opens up this security for the investors, like institutional investors, insurance companies, to then operate by offering insurance on the loan portfolios, or in the case of investments, to buy these investments, thinking they're as good as buying bonds in the most stable companies in the world, when in fact they're built on lies. These lies are these mortgages were not well underwritten, and they were too high for these borrowers who may not be able to pay for the mortgages and therefore default, and the thing collapses. So what happened? It collapsed. This house of cards collapsed, and greed caused all this to happen. So the unsuspecting buyers of homes now commit themselves to much more by way of debt than they should. They eventually can't do it, and the house of cards falls. So the loan default triggers the loan insurance to kick in, which becomes inadequate. And then the prices, when people realize these are not AAA, very safe investments, they're going to dump it. They're going to sell, and that's going to collapse the price of these mortgage securities. They're called mortgage-backed securities. And all of a sudden, everyone goes scrambling for the doors. And it causes a calamity not only in the U.S., even though this issue was caused in the U.S., but it's global because U.S. companies deal with global companies by way of investments and also sharing of risk. So this caused a global financial crisis, all because of greed, put it very simply. And the end result is loss of billions of dollars throughout the system, a loss of investor confidence generally in all parts of the market, which again we cannot have, and failures of investment banks and stress on all other participants. And the government had to step in and bail out companies that arguably maybe shouldn't have been bailed out because they exercise greed or neglect or inability to do their job. Whatever the reason, doesn't matter. But many of these got bailed out, and the end was high cost but a stabilized business for mortgages and what we call the securitized business in the United States. So that's something we vow to never happen again, but I see shade and hints of crazy things happening again. By crazy things, it simply means there are loans being made when they should not be made. And that could be, again, for more mortgages in more recent times because, that won't happen again. Or they may be to students that can't repay their loans. So all of a sudden these loans that look safe and they're sold as securities, they're not safe either. So there's many signs of risk looming in various parts of the mortgage or loan market. So that's ugly. Let's get past ugly.